this cost of capital in financing decision, it is going to help in knowing that what should be the capital mix. As you are aware, we have discussed in the last few lectures about the EBIT and leverage. In the EBIT, we are trying to take up that what should be the mix of capital. That how much equity, how much preference, how much debt that we are supposed to bring in the company, that what should be the combination. So cost of capital, because we always try to reduce the cost of capital. So the combination, that means the mixing of the various sources will be decided on the basis of the overall cost of capital. So we can say that cost of capital will also help us in constructing the capital structure, or we can say it is going to help in the financial decision aspect. Right? One thing more here, there are two things. One is known as explicit cost of capital, and second is known as implicit cost of capital. Whatever that we have discussed till now, that means the expectation of the various sources, expectation of equity, preference and debts, and we calculate the overall cost of capital. So the expectation of these three, who are the external sources, that is known as the explicit cost of capital. That means if we calculate that this thing has to be as 20%, then 20% will become the explicit cost of capital. Now what is implicit? What is implicit, we can say? If the company distribute the whole amount of profit, because as you are aware, from the profit portion, first portion will be given to preference share as the promise has been made. Second portion will be given to the equity share. And suppose after distributing to the equity share, some amount is left, then actually that remaining amount after distributing to the equity share belong to equity share only. So they can be further distributed. That equity share has been promised as 25%, but the company is remaining with 30%. Then after making the payment of 25%, 5% remaining, that can again be additional amount of dividend to the equity shareholder because they are the owner. But question arises that if the company distribute the full amount of dividend, then the company will not left with any amount of profit. Then what will happen in the next financial year? Because now company has nothing for running the company in the next financial year. Company requires the working capital. Certain expenditures they are supposed to meet. Or we can say the company has some expansion projects. Company has some expansion project for the near future for which the company has to generate the fund. So either the company can give the full amount to the equity shareholder, and for some expansion project or next year requirement, company can again invite the capital from the market, or company can go for retaining some amount of profit, which is known as retained earning. That we can say retained earning. That means after making the payment to the various sources, some amount, or we can say as per the policy of the company. Means company can bring in its policy also, that whatever the amount of profit the company received, from the profit, some portion of the profit will be retained as retained earning, fully given to preference share, and then after that whatever amount is left after retaining, they can give to the equity share. But when the company go for retain, Whose money it was? It was of equity share. That means company has to compensate. Company has to compensate for retaining. Either company can go for making the issue of additional share to the equity share against the retained amount. This additional share issued to the equity share against the retained amount is known as bonus share. Bonus share is nothing but it is basically the additional amount of shares issued to the company against the retained amount. Or company can go for providing the interest on the retained earning. As the company is making the payment of interest to the debt holder, company can also decide that they can make the payment to the retained earning in the next final means for retention they have to make some payment, and that payment can be in the form of interest. Now, what should be the rate? What should be the rate? If this amount of retained earning was given to the owners, if it was not retained, it was distributed, then the owners, they must have invested somewhere. Owners must have invested somewhere, and suppose the bank rate is 6%. So minimum 6% as a safe and security they must get from the bank itself. If they try to take some risk, they can go for investment in private equity share or private bond itself, and they can increase their amount of return. That means on the basis of the market rate, not less than the bank rate, but more than the bank rate, equal to the market rate, can be considered as the interest rate to the retained earning. That means retained earning, first of all we can say retained earning has, we can say the cost is known as opportunity cost. This cost of capital, suppose the company is providing 10% as the interest. If this interest is not given, then the owners must have invested somewhere. They are not able to invest there. That is why they have brought the amount in the company. So opportunity cost. So this retained earning cost can also be called as the opportunity cost. And this opportunity cost is basically implicit cost. Right? So basically we can say the opportunity cost. The cost foregone by the retained earners, that is known as implicit cost, and that is the earning of the interest of the retained earners. Right? Now, when we talk about factors affecting cost of capital, that what are the factors which decide about the cost of capital? What are the various factors which can increase or decrease the amount of or percentage of cost of capital? First of all, we say in this, it is risk-free interest rate. Risk-free interest rate. What is risk-free interest rate first of all? In this we can say actual rate, and number two we can say purchasing power rate. What I am trying to say, bank give an interest of 6%, 100% secure. They are government bank, governed by the central bank of the country. 100% secure, that means that 6% will be called as risk-free interest rate. No risk is 0, but interest is 6%. So we can say it is risk-free interest rate. But that 6% is the combination of two. 6% is the combination of two. One is known as actual rate That's quite possible, and one is known as purchasing power. If I invest rupee 100 today, I will get some interest. Or we can say that this chalk we are able to purchase for rupee 1 today. But after a year, this chalk can be of rupee 1.25. 25 पैसा 25 पैसा ये increase कर सकता है. One can say the cost of the chalk has increased, or one can say the value of money has depreciated. Earlier the chalk was purchased for rupee 1, now the same chalk is being purchased for 1.25. Economists will always say the value has depreciated. That means purchasing power. That means the purchasing power, that there is decrease in the purchasing power of the money. So along which you called as inflation also. So the risk-free interest rate which is being provided by the bank, that include the actual rate along with the purchasing power fall in the money. The combination of two will be called as, we can say as risk-free interest rate. Secondly, the second fact, that means if the bank rate is going to increase or decrease, automatically the risk-free interest rate is also going to be increase or decrease accordingly. Next is we can say as business risk. Business risk. The sources, they know if the EBIT is increased, then company is at the safe zone. If the EBIT is decreased, the risk is going to increase. So on the basis of the investment proposal and the change in the market environment and the change in the environmental factor of the market, the EBIT may increase or decrease. The decreased amount of EBIT or the decreased amount of sale is going to bring the business risk to the company. So if the project is new, business risk will be higher. If large and heavy competition is there in the market, business risk will be higher. Or if the economic recession is there, business risk will be higher. Or else we can say, due to other uncontrollable factors, if they are known and aware, then business risk can be higher. If the business risk will be higher, automatically the expectation of these sources will also be higher. अगर रिस्क घटेगा तो इनकी एक्सपेक्टेशन ऑटोमेटिकली कम हो जाएगी, लेकिन रिस्क बढ़ेगा तो एक्सपेक्टेशन इनकी बढ़ जाएगी. तो बिजनेस रिस्क, ऑपरेटिंग लीवरेज, ऑपरेशन रिस्क we can say, that is also going to contribute in deciding by these individuals that what should be the individual cost of capital. That bond is expecting, the debenture is expecting 12%. Then on what rate? From where this 12% has been arrived? 12% will be the combination of risk-free as well as business risk. Along with that, the third we can say as financial risk. If the company has invited too much of capital from debts, then interest amount, accountability and liability will be higher to the company. And if the sale decreases, this interest amount, accountability, responsibility will remain the same. That means the financial risk is high. So on the basis of the combination of the capital structure, if the debts are high, the fixed costs are high. And if the fixed costs are high, the financial risk is also high. That means their expectation will also be high. So what is the mix of capital? What is the mix of the capital, or what is the mix of the project capital? That will also decide that what is the expected from these sources. Thirdly or fourthly we can say as other conditions in other aspects. Others. Like if higher amount of liquidity is maintained. If the higher amount of liquidity is maintained, or we can say not the higher, liquidity is maintained. If liquidity is maintained, that means safety is there. If safety is there, automatically their expectation will be lower. Right? So means we can say that when any individual who is making the supply of money to the company and they will expect some amount of interest or other form of benefits, then they will try to calculate that what is the risk associated for the investment. Means first of all the opportunity cost as well as the risk associated. So we can say on the basis of risk-free interest rate, on the basis of business risk, on the basis of the financial risk and any other risk on the situational basis, we can say all the three, all the four, all the five combinations, they will be combined together just to calculate the individual cost of capital. Right? So these can be said as a factor. One more aspect is there. We say as specific cost of capital, as well as sometimes it is called as overall cost of capital. They are nothing, don't get confused. This is specific, and this can be said as overall. So sometimes it is written that how we can differentiate between the specific cost of capital and the overall cost of capital. That means the cost demanded or expected from the various individuals, they are the specific cost of capital, and when we take the average of all the various sources, it will be known as weighted average cost of capital. So I hope in this way the basic concept about the cost of capital is being discussed and constructed properly. These are the we can say the utility, the purpose, that why we are calculating the cost of capital, because it is helping in financing as well as in investment decision. There are two types of cost of capital: explicit and implicit, specific and overall, and these are the various names which have been given to the cost of capital. Somewhere it is known as minimum rate of return, means internal rate of return is different, that is return itself. And these are the decision making, we can say, decision rules, that return should be higher than cost of capital, less it will cost to the company, means out of pocket will be there. That means now our effort will be to calculate the overall cost of capital, and that we can do by calculating the cost of debt and then cost of shares. Or we can say that we can go for calculating the cost of debts, which will bring the bond, debentures or borrowing, then cost of preference and then the cost of equity, and then we take up the overall cost of capital of the company. Right? So as we have discussed about the risk and return aspect, one more thing that you can understand, that what is the relationship between risk and required rate of return. One more name can be added to cost of capital: required rate of return, minimum rate of return and required rate of return, hurdle rate, target rate, standard rate, opportunity cost rate, break-even rate. All the names mean we can say required rate of return is also the cost of capital. Like see, we can say as risk. Suppose we try to plot. Here we can say we have return, and here we can say we have risk. Means I am just trying to show you a graphical representation between the relation between risk and required rate of return on the basis of factors that we have discussed. This portion, this is basically risk-free rate of return. That means we can write here as when the company go for the investment in government securities, then this portion will be known as risk-free rate. But now if the risk is increased, suppose the company go for public bonds, that means bonds which are issued by government. Again the risk will be increased if they are issued by private companies. Again the risk is going to increase if the company make the issue of preference share. And again the risk is going to increase if the company make the issue of equity shares. That means this portion is known as risk premium. This is the risk-free rate and this is the risk premium. And then we are able to calculate this is that as the risk premium is going to increase, automatically the return is also going to increase in the hands of the cost of capital or the various sources. If you try to reduce the risk, automatically the cost of capital will also be reduced in this case. Right?